Good day, fellow investors. When it comes to investing, it's not about what to buy when. It's about having the correct strategy on how do you want to grow your wealth. And the goal should be to maximize your wealth level in the long term. And that is the key question we have to answer before investing even 1 cent. Because if we look at stocks, yes, stocks over the last 20, 30, 50, 70 years have given 10% per year. There were periods of 15% over a decade and periods of 0 over a decade. We are now in a good period. However, if I look here, you can buy stocks, but if there is a bad period, you might not reach the maximum of your wealth over time. In good periods, everyone makes money. In bad periods, not so good. And most of you here on my YouTube are still investing, hopefully for the long term, given your age. And if we look at the market, we have had slow decline, but since then it has been going nothing but up. However, this reminds people of 2000, okay, and then there was a decade or more of ugliness with some ups and downs. That's how it usually goes. But what to do if this happens going forward? It might go up, continue, but also it might look like this. If you don't make any returns over the next 10, 20 years, then you will not maximize your wealth over the long term. And you still have a lot of years, because if you're a value investor, this is the expected working age for us. So how can we maximize certainty when it comes to reaching the desired level of wealth? So not maximizing gambling, but maximizing with a high degree of certainty. Option 1 is stocks only go up 10%. We just discussed BlackRock yesterday. You can double your money in 5 years, which is 15%, so even better than stocks. Bitcoin, all else equal, if we continue on the current macroeconomic monetary policy environment, I'm sure Bitcoin will also hit $1 million in the next decade. No problem there. However, if I ask myself, okay, I can invest on prices going up, Bitcoin going to $1 million, stocks going to 12, 15, 20,000, it can happen. However, if I look at the cash flows there as driver, then I look at the dividend yield is just 1.18% at the historical lows compared to historical averages. And yes, times have been great, but what if bad times happen? 9 years, 68% down, 14 years, 63% down, 9 years, 60% down measured in real terms. So good times happen, those are followed by bad times, good times, bad times, good times, bad times, good times, followed by time will tell. As I always tell you, my crystal ball broke when my kid was playing with it. To get to 0 in bad times, 25 years, 24 years, 13 years, and trust me, in ugliness, with the 1% yield, or 2 if the market crashes, but 1 on your cost, it's very ugly to be there in 13 years. Especially if, given the current size of the bubble, it takes a quarter of a century to get back to 0. Just discussing the risks, not predicting anything. So what is option 2? Let's go to cash flows as drivers, not S&P 500 dividends. We need better dividends, better buybacks, better things. We need higher yields. Where can we find that without increasing the risk? One of the stocks that I discussed in some videos is Amsterdam Commodities. P ratio 10, dividend yield 5%, not P ratio 30, dividend yield 1%. This business is also growing earnings at 8% per year over the last decade. So what is more certain of driving me to my financial wealth? A bunch of businesses like these or the S&P 500, because I want to do well even when and if bad times happen. And you can check here my performance in this video. I did perhaps a little bit better than the S&P 500 over the last 7 years, but the key difference is P ratio of 10 compared to the P ratio of 30. Let me just compare here. Dividend 5, growth 8%, S&P 500 1, growth 7%. But yes, if you invest like an old, boring value investor, then you will miss out on the S&P 500, on gold, on Bitcoin, on all those things that just go to the moon. But when it comes to investing, as we discussed, does price matter? Is that a risk? Warren Buffett's letter discussing how we are enormously indebted to those academics. What could be more advantageous in an intellectual context, whether it be bridge chess or stock selection, than to have opponents who have been taught that thinking is a waste of energy. Thinking, stocks only go up, you don't need to think, just invest. Warren Buffett, thanks to those that they had lost their shirts in the 70s, bought all on the cheap 70s, in the 80s. After the crash of 87, when the markets reverted, he bought Coca-Cola on the cheap. And 2000s, 2009, Burlington Northern, always buying these things on the cheap. That's Warren Buffett. So who will be right? Only time will tell. When it comes to these fear of missing out things, okay, give me investors that have compounded on momentum stocks for the last 2-3 decades. Maybe you can make money once, twice, but then you lose it on the third ride. And that's the key when it comes to compounding long term, is not losing money. Because if you miss out of these momentum stocks, you miss out on NFTs, marijuana stocks, biotech stocks of the 2012, what else is there? Real estate of 2007. You miss on that, dot-com boom, you miss on that, and you keep compounding in the meantime. It's the key decision to make what will be the driver of your long-term wealth accumulation. Fundamentals or momentum. I've made my decision in 2002. The S&P 500 did greatly, but I'll still stick to my decision because I fortunately did better. Because there was this 10-12 years when I did great and the others were destroyed. You can check my video here on the risk and reward educational quadrant on YouTube. There are some stocks, 8-9% yields, 5% yields growth, very interesting. Or you can check the premium version with my portfolios on my research platform. Make the decision before you put any dollar into investments, and let me know what you think in the comments below.